Okay, thank you for giving me this opportunity for sharing my views on how fintechs are enabling use of financial statements in the area of paperless credit and digital lending. I'm here on behalf of a new age digital lending fintech, ScoreMe Solutions. I want to take this opportunity for sharing the role fintechs are playing in partnering with banks and NBFCs in analyzing credit and systemic risk, and how they reduce cycle time in the area of lending and make the process of lending paperless and digital. So before I actually delve into the subject, I just wanted to share a personal journey before the growth of fintechs and digital banking actually came into picture. This was way back in the year 2002, when I applied for a home loan for the first time. There were three broad challenges that I faced. I had no digital platform to disseminate any information, so I really did not know how the loan process would work, what were the competitive rates on offer. The process was manual, it was very tedious, and so I had to share my paper-based statements, and there was substantial back and forth between the banking institution and myself. And finally, there was constant lack of communication and the time it took. So it took more than about 60 days, and right until the last day, I had to actually locate the agent who was carrying the loan check. So it was a very, very tedious and manual intensive process. So since then, times have really, really changed. Those times have changed remarkably with the advent of fintechs. Digital banking and fintech has nearly become omnipresent today. Right from wealth management, insurance, payments, RegTech, all the way to digital lending. Just to share a quick perspective on the phenomenal growth of fintechs in India today, one estimate is suggesting that the fintech market is expected to grow to about 8.35 lakh crores by 2026, in comparison to 2 lakh crores in 2020, thereby expanding at a compounded annual rate of 24.5%. So it's been phenomenal growth as far as the fintech industry is concerned. Now, there are broad elements in India. So India today has the third largest number of fintechs globally after China and US. And the more pleasing picture is that it has the highest adoption rate in terms of fintechs. So it has an adoption rate of almost 87% as compared to a global average of 64%. The number of digital transactions is actually expected to rise to about 50% by 2024 and is expected to touch to about 72% in 2025, thereby actually exceeding the paper-based transactions, something that was unheard of in the year 2002. So one of the most pleasing aspects of this digital growth has also been the growth in terms of the rural internet. So rural internet has been growing at the rate of 30% CAGR in the last 5 years. And we've reached now nearly 336 million subscribers just in the rural segment. And we're expected to touch an overall number of about 1.5 billion internet users in this country by the year 2040. So these are phenomenal times. These are changing times that we're living in. So in my view, there have been broadly three phases of financial services and digital financial inclusion in India. So the first phase was from 2014 to 2016, with the growth of Jan Dhan accounts and the growth of payment wallets. The second phase was from 2017 to 2021. This was driven by the introduction of UPI. There are now 250 million users on UPI today, and this is expected to scale up to about 750 million in the next 5 years. Even on the merchant side, we have about 50 million users who are using UPI today, and that's expected to grow to about 100 million. So a 10x growth in the next 5 years is what is expected. I now believe that we are in the third phase of financial inclusion. This is being led by digital banks. This is being led by neobanks, digital lending, and this partnership between fintechs and the new emerging account aggregator model. This account aggregator model is going to do to digital lending what UPI has done to payments. This has been growing at the rate of 28% on a week-on-week basis. The account aggregator essentially has two parts to it. There are financial information providers at one end, and then there are financial information users at the other end. So this allows fintechs like us to be able to get access to financial statements, to GST returns, ITR returns. It becomes very easy and seamless for us. And this is one of the central provisions in financial inclusion. So access to this information enables access to credit. Of course, it's still a long road ahead as far as India is concerned. One estimate is suggesting that only 10% of the outstanding credit is still via digital means. The biggest challenge, of course, is on the MSME lending side, with some studies indicating that about only 10 million of the SMEs are still covered via formal credit means versus the overall 68 million population of SMEs that we have in India today. So there's clearly a long road ahead. If you compare to the more advanced and the more digital inclusive economies, 20% of the loan disbursement today in the developed markets happens through digital means. Our credit to GDP ratio, it's at only about 55% as compared to 160% in China, and it's even lower as compared to emerging markets, which is at 135%. So there are several supply-side constraints in access to credit. There are high transaction costs, there's low product innovation, limited underwriting capability, and that's where a fintech provider like us can come in, and that's where digital lending can help. So in India, we are observing this unique model of phygital approach. So banks will be acquiring customers digitally and servicing customers physically. That is one approach that we are observing. At the same time, the reverse is also true. Banks acquiring physically and then servicing digitally. Therefore, digitization can help alleviate the costs around acquisition of customers, credit underwriting, and then finally monitoring and collections. So there are new models that are emerging as a consequence of digital banking. There is the new BNPL model, and that's extensively now getting used in the SME and retail lending. The existing BNPL market in India is around $3.5 billion, expected to grow to about 45 to 50 billion by 2026. Research is also estimating that the number of BNPL users in our country will rise to about 100 million customers by then, from the 10 to 15 million currently. There are now net 500 plus digital lending apps just in India. So hugely exciting times, as I mentioned earlier. So this is the new model on the account aggregator side that is going to develop in India. So this new model is called OCEN. It stands for Open Credit Enablement Network. So data, as they say, is the new oil. And essentially, all the loan service providers, they have substantial information about the end customer or the end borrower. So let's say whether I'm a HR tech app or a food delivery app or a Kirana store app or a B2B marketplace, I have substantial information about the borrowers. So they can then become agents from the borrower's standpoint. They can offer this information to the banks, who can then do a cash flow-based lending model and can use alternatives to the balance sheet model that was being used earlier. So the idea is to basically enable lending in a very seamless way and to allow monitoring and collections also to happen seamlessly. So this is going to be the new way forward, and this is going to be the UPI for lending in the road ahead. So just wanted to share a quick perspective about ScoreMe. We are essentially a fintech in the area of paperless credit. We are parented by a tier 1 merchant bank, and we are essentially a banking firm that has adopted fintech. So today we have about 150 odd members spread across 6 cities in India. We serve more than 200 plus financial institutions, and our idea is to make the credit analytics process digital. And so with presence in 6 cities, we are able to serve our banking and NBFC customers seamlessly. So our models enable digitization across borrower identity validation, eligibility checks for corporates and SMEs and retail borrowers, There's document e-processing. So there's e-sign, e-mandate, e-stamp. And so eventually our model is to move towards a digital lending platform. Our algorithms allow for automation of credit risk underwriting, monitoring of borrowers, and journeys right from the identity to the credit risk underwriting all the way to the disbursement stage, and even to the post-lending stage where we can enable watch lists, we can enable auto renewals, and we can do an end-to-end digital lending journey. There are multiple areas that we can cover. So for instance, there's something called as bank statement analysis. This is central to any cash flow-based lending model. So the idea is to gain in-depth insights into the credit debit transactions, any in-house related party transactions, what's the kind of cash flow, are these salary payments happening on time, are there any check returns, online returns? All of this analytics can happen through bank statements. We can do analysis of financial statements where we can automatically build balance sheets, P&Ls, we can do ratio analysis, we can do analysis on other directorships. GST has been a big boon for us. So we can get information on customer and supplier concentration risk. We can get information on geographic concentration risk, defected return products, all of those analysis via GST statements. Legal data analysis, another very important element when lending to retail and SME borrowers. So the idea is we can get information all the way from Supreme Courts to IBCs, tribunals, and MCA watch lists. We can classify these cases in terms of petitioner or respondent, and then we can quantify the risk in terms of high, medium, and low-risk cases. And our eventual objective is to build an integrated analysis solution. So the idea is to blend in information that's coming from bank statements, from GST, from financial statements, from legal data, and to build a quasi-CAM, which can be customized and digitized as per the credit team. So to give you an example, one can validate if the GST receipts versus the payments made have actually been received via the bank statements. So that kind of triangulation can happen between bank statements and GST receipts. So quickly, to give you an example, let's say an SME approaches a bank for a loan. So our APIs will access and enable credit eligibility by analyzing bank statements, GST returns, financial statements. This will make the job of underwriting seamless. And these APIs can combine with the rule engines at the banks. And the idea is to give an in-principle loan eligibility in under 30 minutes. So that's the kind of target that we're looking at today. We've recently also built an innovative offering on the post-lending stage. This offering is called Sampan. It stands for Simplified Analysis of MSMEs using PAN. So just using PAN, we can access information on GST filing, we can get information on legal data, on financial statements, and we can combine this to generate a signal to the bank branch for a go, no-go decision on loan auto renewals. So this process, we were talking to one of the financial institutions. This used to take almost a month to 2 months, can now run as a batch process overnight, and we can do the loan auto renewals just as an overnight process. So finally, what we are doing is we are bringing all of this together in the form of a loan origination disbursement journey. Our idea is to blend all the credit analytics APIs and bring it together in the form of digital journeys and the co-lending model that the government has recently initiated. So just to summarize, our idea is to fuse human intelligence, bring in data from financial statements, from bank statements, and build digital machine learning models. The idea is to reduce risk, improve operational efficiency, and enhance transparency in lending decisions. We are able partners in digital journeys with banks, NBFCs, and financial institutions. Our idea is to make lending decisions faster, paperless, seamless, and to enable financial inclusion in India. Thank you.